Brian here. It's Wednesday the 19th, and the market did not finish the way a bullish person would like it to. That is, we gapped up and failed pretty quickly and stayed weak below that volume weighted average price the entire day and back below this 5 day moving average, which is declining once again. We are also below the volume weighted average price for the week and for the last 2 days, as I had pointed out in a chat room post that it looked like maybe those levels were going to hold as they all kind of came together with those two VWAPs and the 5 day moving average, but it did not, and that's why we were midday. I was saying that it's turning more neutral, but very cautious not to say that we're being positive once again, because we still have this overhead supply to deal with, and we do have a pattern with with these lower highs in here, and being rejected at this prior support now puts a little bit more pressure on this market and in the near term. When we take a look again at that year-to-date volume-weighted average price, that's where this market has been finding buyers on the deeper pullbacks. Looks like we're due to test that once again. And other people talk about the 50-day moving average, which is still rising, but we're below it. But again, I think the year-to-date volume-weighted average price is more important. And if we're to break through and close below that level, in particular below the March lows, I wouldn't be surprised if we saw a rather rapid descent down towards the volume weighted average price since the election in this prior band of resistance. So it's clearly a time to continue to be more cautious, especially when you see stocks like Goldman Sachs imploding and below their volume weighted average price, not only for the year and since the election, but since the lows of the fourth quarter. And then, of course, today you had IBM get hit pretty hard here. And this stock is also below these key volume weighted average price levels, and oil declining. So that just doesn't put a lot of confidence in participants in this market, and they start to raise capital, for where they can to reduce overall risk. So the market, I think, right now we have to be a little bit extra cautious. Fortunately, we've had some great stocks short this week. We had some real nice stop outs on stocks like Ambarella and AMBA and then Tempur-Pedic. We got stopped out before these big bounces in here. So those are the types of moves, if I could type properly, that I could show you here. So, being out near the $40 level after a $3 bounce today, that's the type of thing we're looking to do each and every day. Obviously, not every day is going to be as great, but we had some real nice longs today as well. So let's take a look at the NASDAQ now. NASDAQ still kind of in this overall range. We did close, right above that 5 day moving average and what had been a little bit of band of support turned resistance. Now it's just kind of more neutral here on the NASDAQ. So keep a close eye on the way things are developing. We don't want to be too quick to get bearish on this market because we have the bigger potential for support down near 129.5 to 130. And we are still, above that 50-day moving average for now. And the bigger level that we've been referring to is, of course, that year-to-date volume-weighted average price, which if we were to break significantly below this lower band of support, I think that would become a quick target. Right now, there's not showing any signs of it, but you can start to look at things like, is this a left shoulder? Is this a head? And now we're building the right shoulder. Don't want to be bearish just because you can see a pattern emerging, but it is something to be aware of and to try to determine what the potential scenarios might be if that in fact does come to fruition. Now, the Russell 2000, as we know, continues to hold above that year-to-date volume-weighted average price in this bigger band of support, 132.5 to 133. Today, we saw some progress in this market as it did finish with a gain of 51 cents, but it fell short of that 50-day moving average intraday. So this 50-day moving average has been finding sellers, and that's not something we want to see. Each time it fails to break through there, it weakens the resolve of the buyers and increases the chance that more people will be taking profits. If we can get back above and hold above 137, it turns it a little bit more positive in the intermediate term. But again, that's more positive in the intermediate term. Given this overall range, it would be really nothing to be excited about either. Semiconductors bounced a little further today. As we know, they bounced from the year-to-date volume-weighted average price last Friday, and now what we're looking at on an intraday basis is the potential for resistance up near this 78.50 level. That's the level we've been talking about. We're getting a little bit of a bounce, but I don't see a decent risk reward in here for any long exposure. So I think the semis are probably just in a void. And the biotechs, which have been bouncing along that year-to-date volume weighted average price and testing with more and more frequency, continue to show the pattern of lower highs and lower highs as we pressure down on that. And eventually, it's either going to break down through that level and we'll see a quick sell-off, or the shorts are going to get squeezed if the buyers can regain their resolve here. For an intermediate term perspective, to get this market a little more neutral, 229, 292 to 292.50 is what we need to see. If it can get back above there, that's a start. It's not a reason to get bullish on this group, but it is definitely a start.